Hello, friends. Fed has delivered another dovish hike, signaling rates are nearing the economy's tolerance threshold, and it has essentially removed the word accommodative. So initially, dollar was offered across the globe in response to this development. Suggests that markets took it as a sign that the policy tightening is coming to an end. Indeed, that's right. That was the right conclusion, uh, uh, because the dot plots haven't changed. Fed is still penciling in another rate hike for December and three more rate hikes in 2019. So, and at the same time has removed the word accommodative. So, it indeed suggests that policy tightening is nearing an end. However, if we look at the euro dollar chart on the screen, we have a big candle with a long upper shadow, and it suggests that dollar has made a strong comeback. So, what's exactly going on? I feel the tone of the statement was indeed dovish. We are nearing an end of the policy tightening cycle, but still rates are set to go higher by about 75, about 100 basis points over the next uh, 12 months. And that could be the reason why dollar has made such a strong euro dollar has dropped sharply, because it says that even if the Fed policy is nearing an end, wider the yield differential is set to widen further in the USD positive manner. Also, we have a press conference, and there's always possibility that Fed president might say that they are ready to hike rates above the neutral level of 2.87% if inflation keeps rising. The press conference is about to begin now, and in case Powell says that Fed has very less tolerance for above target inflation, then the drop in the euro dollar could be deeper. However, if he remains silent and reaffirms the gradual path of rate hike, then euro dollar might end the day with moderate gains. In any case, as we can see, the candle it looks like a big doji right now, and it's as far as trading is concerned, on the higher side, I would like to see I would like to see the pair close well above somewhere around 1.1852, which is June 14 low. If you remember, it's a ECB day high, and ECB day highs and lows usually tend to work as a strong support and resistance level. So, in case we close above June 14 high of 1.1852, then I would suggest 1.20 would come soon. As of now, it's clearly forming a doji candle, and yes, the first comment flowing in is that gradual return to normal interest rates is helping sustain the U.S. economy. So, he has reaffirmed a gradual path of tightening. Overall, financial conditions remain accommodative. Absolutely, our economy is strong, inflation is low and stable. So, for initial comments suggest that they are sticking to the gradual rate hike path. So, dollars rebound should halt here. all in all, I feel dollar could take a beating tomorrow. Not a very big one, because as I said, even if the policy tightening is coming, has moved closer to its end, yield differentials, or let's just say interest rate are to go higher by another 100 basis points in US, and that's a significant. So there is still, uh, theoretically, there is still room for widening of yield differentials in the USD positive manner. On the other hand, other central banks are still miles away from rate hike, and it's my personal opinion that as long as Fed is ECB would move rates only after the Fed is done with raising rates, or once the Fed hits the end of Fed's policy tightening ends, only then ECB would seriously start telegraphing its first rate hike. Till then, neither ECB nor any other major central bank is likely to begin serious policy tightening effort. So that is the reason euro dollar might suffer only moderate losses tomorrow. Nothing big, but yes, the bullish momentum will wane. The biggest beneficiaries might be the emerging market currencies. They might be in for some relief, but that would be temporary. Again, the logic is same, that rates can still rise by another 100 basis points, and that's a big deal for EMs. So let's say, for example, USD INR may gap down tomorrow, and the gap might be filled uh, quickly. So the latest comments on inflation goes like this: the central bank expects price pressures to remain near 2% on a sustained basis. The important word here is remains near 2%, and there is no comment on what if the inflation remains above 2%. 2% is the inflation target, and let's say if Powell says, or if you would have said that inflation may remain about 2% on a sustained basis, then the expectations of a higher than a neutral rates would have gone up. But so far, we haven't heard any such comment. USD is 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 again picking a mild bid. Okay, so Powell is doing a balancing act here. He is stating that dropping the word accommodative does not signal a change in policy. It shows we are moving in line with expectations. So, what he's trying to say is that market should not read uh, its decision to drop the word accommodative as a hawkish development or a dovish development. And uh, all in all, yeah, he's trying to say that the Fed will continue to raise rates at a moderate pace as they have been doing. Yes, so the next comment is gradual rate hikes allows Fed to carefully watch incoming data so to see how it is processing higher rates. So uh, I think the conclusion here is that Powell is indeed saying that dropping accommodative does not signal a policy change, but they have begun informing markets, or I would say telegraphing. They have officially started telegraphing the end of the tightening cycle. Unless oil prices continue to rise in the near future, if they do, then the prospects of higher than neutral rates would go up. As of now, a neutral rate is seen around 2.87%. So, if indeed oil continues to rise, then markets may start pricing in increased odds of Fed pushing the rates about 2.87%, and that's something that could put that a strong bid under dollar. But as of now, I'm here. I'm reading a tweet which says, CNBC is asking about the stock market. I'm not sure how true is that. Another comment flowing in is central bank does not consider political factors in deciding the policy. So here's the conclusion. Fed hikes rates by 25 basis points, removes the word accommodative, suggests that market should not read too much into that. But my feeling is that the removal of the word accommodative marks the beginning of the Fed slowly telegraphing the end of the tightening cycle. This is indeed slightly dovish because the dot plots haven't changed. Had the dot plots gone up, uh, and in that had the dot plots gone up, then the policy would have been hawkish. But as I said, it's still penciling in another rate hike for December and three more rate hikes in 2019. So no change over there, but has removed the word accommodative, which obviously tells me that the policy tightening cycle is nearing its end, and that is uh, somewhat dovish. Of course, as I said, the yield differential is there is still scope for 100 basis point rise in the US Japan or US Germany yield differentials. So that that should support dollar in the near term, but the bullish momentum will struggle. As far as EMs are concerned, might offer some temporary, very temporary relief to EM currencies. The fact that they are nearing the end of the tightening cycle, but nothing significant here. As I said earlier, dollar INR may gap down, but the gap would be filled pretty quickly. So here is the latest comment of Fed's Powell saying it's hard to be confident that rates need to be above neutral level in 2020, 2021. So he's indeed it's difficult to say where rates will be a couple of years down the line. But as I said earlier, if oil prices keep on rising, the probability of rates moving well above neutral territory would go up, and the dollar would pick up a strong bid. So going forward, I would keep a close eye on oil prices. If oil is dumped heavily, the dollar would pull back across the board. Let's look at the technical charts for majors. I would like to start here first with USD JPY. So it's about 113. It was destined to go above 113. As you can see, we had a bull flag breakout, sort of a bull flag breakout in on September 13th, and that only reinforced the bullish expectation, bullish case put forward by the nice higher lows along the 100 DMA, and now it's trading well above 113. It has clocked the high of 113.13. The RSI is bullish, closing in on overbought territory, but still a bit of gap there between 70. still a bit of room available. So we can easily challenge the yearly highs, some located somewhere around 113.39. But the move has to happen in the next, let's say, 12 hours or so, because if emerging markets emerging markets do not respond positively, then the risk of could put a bid under Japanese yen, making difficult for the pair to scale the yearly highs around 113.39. So bias here is clearly bullish. If we look at the monthly chart, it looks even more attractive. Having scaled this long-term falling trend line in earlier this month in a convincing fashion, that too, we are now heading up. This is a seriously bullish chart. If you zoom out, I can see a big, massive inverse head and shoulder being formed. And what we have here is the pair is currently charting the right shoulder of the inverse head and shoulders pattern, and uh, we also see a large bullish pennant breakout. It looks like a done deal. The breakout looks like a done deal. As I said, unless and until there is serious risk aversion in the next couple of days, this pennant pattern has been breached on the higher side. And technically speaking, it has opened the doors for a rally to 126.67 or something, which is the neckline resistance of the inverse head and shoulders pattern. What, of course, the rally to 126 is not going to happen within a couple of months. It might take, another 8 months or 10 months or maybe 12 months. But you have to keep an eye on this pattern because it's an inverse head and shoulders bullish reversal pattern, which is being formed right at the bottom of the multi-decade downtrend. And going by textbook rules, the bullish reversal patterns have to appear at the bottom of the trend. They work strong. If inverse head and shoulders appears at the top, it tends to work as a bull trap, because being a bullish reversal pattern, it needs a strong it needs to be preceded by a strong sell-off. And uh, remember that dollar yen was trading well above 350 in 1970s. So from there, it's come down to 75 by 2010, 11, and now it has started a inverse head and shoulder. So you have to keep an eye on this pattern. It looks seriously bullish. Coming back to euro dollar. So last week's long tail candle signaled bearish exhaustion, and it gains more credence given the fact that we have produced a positive candle this month. In case this month's close is above 1.1733, then uh, it would likely embolden bulls, and we could attack. Maybe we could peep above 1.19 in the next month or two. So the focus is on whether it will close about 1.173334 on this Friday. On the other hand, if it breaks below, let me just remove the Fibonacci to make it more clear. On the other hand, if it breaks below the ascending trend line support, which is currently located around 1.1685, then it would confirm a downside break of the rising wedge, and that would only signal resumption of the sell-off. In which case, the first target would be 1.1526, which is September 10 low. So right now it's in sort of no man's land. I would not want to trade it here. If it breaks, if it suffers a rising wedge breakdown, I would be a seller. On the higher side, as I said, if it closes above 1.1733 this weekend, I would want to be a euro dollar buyer. Fucking dogs are barking their ass out. Couple of comments from Fed Powell says trade tensions effects are still relatively small, so that's somewhat dollar positive. Business contacts around country showing rising chorus of concern about trade tension. So again, a balancing act, nothing serious here. Counter-cyclical capital buffer remain a tool that could be deployed. Fed to carefully watch in case inflation reacts more strongly or weakly than predicted. Indeed, if it reacts more strongly than predicted, then markets would start pricing in the prospects of above neutral interest rates. So keep an eye on that. So that's it for today, and I shall see you next time. Thank you.